of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you, learn of your own financial condition. My position disclosure is the same as yesterday, except I got stopped out of UVIXI and VXX for a loss. Sorry. I need a second. I need to blast through that. I gotta manage this position. Chewy is actually like my biggest position, believe it or not. I dumped a lot of stock, so it's no longer my biggest position. Actually, I guess technically it wasn't anywhere to begin with. Second biggest. Micron up after hours on earnings, so that's helping the market further. Why not? Chewy up after hours on earnings, most important company in the market, so that's helping. I really sometimes wonder if Chewy is more important than Nvidia. It's hard to say. I knew somebody out there loved their pets, though. I mean, come on. Come on. Of course it's a joke. Pat makes that joke kind of all the time. It's where I swiped it from. Yes, obviously today was a really important day, so I don't want to be overly stuck trading this thing, but it's one of those situations where it's like, I love you guys, I love the afternoon meeting, I love helping everybody to improve, but I gotta make money. So I'll do my best to juggle both, but this thing, I'm trading it like super rapidly here after hours. Didn't even fully fulfill the measured move up there. Ooh, that was a quick down tick. Wow, quick down tick, quick up tick. Bids get lit up, offers get lit up. This is what Chewy's doing after hours. You got some dots in there, some buy dots, some sell dots. The funny thing is I don't have a pet, right? I like animals a lot, though. I just can't get myself to settle down in one spot. Apparently the previous owner of this house that I live in, who also is the person who built the house, he had a pet skunk that he had deskunked, which I think sounds really cool. My neighbor was telling me that the skunk's feet was the softest thing he's like ever felt in his entire life. I could use that. I could use one of those. Take out the voles in the spring as they come along. All right, so today was a monster day. Yeah, apparently you can do that. You can have a pet skunk. You just gotta de-smell it. Yeah, that's a great. Keep away the unwanted neighbors. Don't tell them it's de-skunked. Just let them roam around outside. I love it. There's been a big refreshing seller in this Chewy the whole way up. When the earnings report first came out and this thing was exploding higher, $19 was dumping stock, and then released and was selling higher and got up to like 1950 or so, which is where I got partialed. And then they jammed it back down, and now there's a massive seller right now at 19.25, which if anybody wants to learn to read tape a little bit, I'm talking so I didn't actually see which exchange he's selling on, but next time the stock tests 19.25, which hopefully happens again, we can all look at this thing and see if we can identify that refreshing seller, see if that seller is still there. Someone's absolutely dumping this Chewy into this report. Looks like everything's continuing higher. Some of my other positions are continuing higher here after hours also. All right, so the SPY finished up a percentage point. That's including the after hours action. The Qs finished up 1.5%, super impressive, and the IWM's up 2.25%. The Russell is back, baby. All right, I gotta calm down. So, coming into today's trading session on a more serious note, we have been discussing this market had become much more neutral coming into this economic event, the Fed today, which this Fed event, I've been saying the last couple trading sessions, seemed like it is significantly more important than some of the recent ones. I felt like this one wasn't as well telegraphed as a lot of the previous reports have been. There's a little bit more uncertainty. The more uncertainty there is into an event, the bigger the movement you can expect to potentially get, because it's surprises that move the market. And if everyone knows exactly what's going to happen, then things kind of become a non-event, which we have certainly seen with some of these Fed meetings recently, where it was just so well telegraphed that there was going to be a hike or not a hike, or holding it steady, that when the event actually occurred, you'd get a bunch of volatility intraday, but it actually would go nowhere. And today it seemed like there was a little bit more uncertainty. How is Jerome Powell going to handle this recent uptick in inflation that we have been seeing? What's he going to do? Is he going to stay the course with the dot plot with 3 cuts, 75 basis points worth of cuts this year, like they've been talking about from the beginning? Or is he going to pull back on that a little bit? Is that going to change? What's the language going to look like? I mean, it was expected that there was going to be language on the Fed's balance sheet as well, on tapering off the reduction of the Fed's balance sheet. So that was, so also some language to pay attention to. But at the end of the day here, as we kind of expected, this was the base case. The Fed left everything pretty much unchanged. The dot plot's the same. Three cuts are still expected this year, and we talked about that, and it just made a lot of sense. Why would they get rid of their optionality by dropping them down to 2? So they're keeping that optionality, but the other part of the equation was, will Powell come out and act significantly more hawkish, potentially while keeping that dot plot the same, and say, I don't know, say anything that could make this market believe that they could not get cuts. And I mean, he's just seemed, from what I saw, as dovish as he possibly could be. He didn't exactly say this, but to me, reading through the lines, he pretty much seemed to say, yeah, inflation went up the last couple reports, but we really don't care about that. That seemed to be what I was saying. I know that he said, like, it's a little bit more nuanced than that, his exact language. It was more like, we recognize it, we think it's just a blip in the radar, but we also are taking it seriously and we're keeping an eye on it. But that's what he said. Reading between the lines, to me, it just seemed like Jerome Powell came out and said, "Hey, we are ready to start pumping liquidity back into this market, so you better be ready as well." And the market absolutely took it in stride. The market took it in stride, right? Just a super strong day. Sometimes, actually fairly often, I would say, you get that situation with these Fed movements where the first move is a fake move and stuff like that. And I always get a little bit nervous when I see traders say, remember, the first move is always the fake move, or anything like that when it comes to these Fed events, because that's definitely not always true. It's true fairly often where the Fed announcement comes out, you see a big quick up move, and then the real move is down, and that first move is fake. But it's definitely not an absolute truism, and it's especially not true when the event is a little bit more unexpected, a little bit more of a surprise, because like I was saying earlier, it's the surprises that tend to lead to the bigger moves. And today there was no fake movement at all. There was a decent amount of volatility. There was a moment there when right before the press conference started, or right as it was starting, that I was concerned that we might break that opening low. A common thing is whenever we have these economic events, we always want to pay attention to that starting point, right? While we're above that starting point, just technically, it's telling you that you're better off being long than short. And then if you ever get below that starting point, that means that you better get out of the way on those long positions that you had on, because every single person that just bought the market in that up move then becomes out of the money. Like, imagine if on this 235 candle, maybe Powell says something or whatever, the market just sells down. All of this volume from that 30 minutes, all that bigger volume from that uptick becomes out of the money, and then you can see a much faster move to the downside. But the market stayed true today. Initial move was higher. We never broke that opening low. A little bit tricky. I did call out a long here off the 215 low, which worked enough before actually failing versus that pivot, but still held the absolute low. Then Powell was just speaking, was as dovish as could be, and this market just absolutely continued higher. The VIX continued lower. The VIX closed below that 1350. I know Pat had mentioned 1350 in his technical analysis portion of his note as kind of the support of this ascending channel that you can see here on the daily chart of the VIX, which now is broken as well. So, I had been trying, because this market had given us a signal here that the market was a little bit more neutral prior to today's trading session, prior to Jerome Powell speaking. I'd been trying to also be positioned a little bit more neutral, have some insurance with some small VIX calls and bigger positions in VXX and UVXY, as well as continuing to have my TQQQ short position, which somehow I'm still pretty solidly in the money on that thing, which is pretty incredible considering how much I've been trading this and how strong the Qs are overall. Having that on, been short Tesla as well, which has been the weakest name that's out there. I barely didn't get stopped out of Tesla today. So we'll see. There's a good chance that this Tesla gap's above my stop loss tomorrow, but I'll take that as it comes. Had a stop in at 1 penny above what that high was in the afternoon. So, was trying to be a little bit more neutral with my own approach and give myself some insurance with this market as we kind of had these warning signals. We had 2 warning trading sessions, right? The 8th and the 14th. And the SPYs here just absolutely blew through all resistance today. It was a super strong day. The Qs got above the high of that 14th warning signal, but have not yet gotten above the high of the AMD NVIDIA day, which is March 8th. So I guess the Qs aren't fully out of the woodworks yet, but they're looking much better. And the IWM, the big winner today was this Russell. Super, super impressive. 203 was a level to get back above. It got above it. It absolutely crushed it. One quick second. Yeah, got above that 203, but then also really needed to get above the March 14th high, which was the day to take notice of, particularly because it seemed like breadth was horrible that day. The SPYs and Qs kind of held in, but the Russell got totally smoked and was retesting 200. And the IWM just plowed through 203, plowed through that 205 quarter level that we had been talking about as well. And the IWM is also back to kind of full-on bull mode here. So make no mistake about it, these markets are looking fantastic. I guess the Qs still need to break one more key level, but we are continuing higher. And it just goes back to one of my favorite sayings in trading: trends can last for much longer than anyone expects that they ever will. And you always want to be able to be prepared for that. You never want to look at a market that's been trending up or trending down and say, this is up too much, it's overdue. Obviously, that's a simplistic statement. We can look at things such as extension and our extension rules to come in for counter trend trades, because then it kind of is overdue for some sort of price or time correction. But it's very difficult to just look at the market and say, wow, we're up 8% on the year and we're only 3 months in, so therefore we have to go down. And this market keeps finding a reason to be able to hold in and continue that trend, whether it's an AI thing or a NVIDIA's earnings report or Jerome Powell and the Fed. There seems to be something that continues to keep this market in, and it was just a phenomenally strong day. So our update on the market is we're pretty much back to full-on bullishness. Maybe that can change tomorrow, maybe. The day after a Fed day is sometimes full of surprises. The day after a Fed day can oftentimes be a trend day. So we'll see if that actually occurs or not. It's a higher probability trend day than probably a more typical day that you might look at. So we'll see. But because that trend day, when it does happen after the Fed, can happen in either direction. And why does that happen? Because a lot of fund managers who are moving big money, they're not making their decisions at 2:01 p.m. today, like the second that the Fed comes out with their report, or making their decisions at 2:32 based on one individual comment that give me 1 second here again. One individual comment that Powell might have kind of let slip or whatever. They're making their decisions based on a broader thought process that takes a night to digest typically. Yeah, they hammered that seller hammered this Chewy all the way back down. I'm not really surprised to see it. Why? Oh, that's interesting. Sorry, I need a second here. Oof. I just make a mistake. I think I just made a mistake. I gotta do some quick math. Okay, I corrected it. I corrected it already. Don't worry. Sorry, this thing is trading absolutely insane with the move that it's having right now. More orders. I got this max limit order of 50 orders. Which is annoying. So then I have to sometimes go in and cancel orders so I can get out more than 50. Okay. Thanks, Rich. I appreciate it, man. What was I talking about? Oh, the day after a Fed day is oftentimes a trend day. So let's just keep that in mind, and that could potentially be in either direction, though. With how dovish Powell seemed to speak today, it seems very hard to believe that we could go down. At a certain point, we're going to have to start paying attention to our extension rules. We are, let's see, ADMA is almost at 515. We're above 520 for the SPYs. So we've got, $6 worth of extension, something like that here in the SPYs, which is notable because that puts us in no man's land from a risk-reward perspective, but we can check that out tomorrow. We're by no means in extreme extension territory, so we will also need to pay attention to that. I think that's pretty much all I got. The open today. The beginning of the trading session was just extremely boring. I hope they broke that seller. The open was just extremely boring. I basically did almost nothing throughout most of the trading session until 2 o'clock came in. That's all I got. I am happy to do my best to answer any questions that anybody has. I'm seeing George Q just say time decay, but I don't know what that question is referencing. So if you want to clarify, I'd be happy to help. From Mike Reed, I took the 930. Oh, and that's right. We did have a couple really good trades. You totally reminded me. There was a couple really good call outs this morning. DraftKings, which was not my call out. I think that came from Jim this morning, but it had been mentioned the last couple of days, ever since this strong day on the 18th was out there. We talked about this break of 44 for the continuation because you're getting above these tails and this high close red on it. I actually liked it. Yesterday was more of a rest day with a downside tail to it. So this trade was phenomenal. Continuation of that strength from a couple of days ago. So that was a great call. And this actually is a great example of something that we were talking about in yesterday's afternoon meeting. In yesterday's afternoon meeting, someone had asked me about, trading in the first few minutes of the open. And I said, one of my favorite trades, period, is those breakouts that are occurring sometimes in the first very few minutes of the open, where you're buying the break of a daily level and just using an opening low or something like that, or a pre-market low as your stop loss. And this is just a perfect example of that. If 44 is the level, this thing opened up at just above 44. There might have been a quick down tick to 43.95. But if you're able to get stock at this 44 area and not get stuffed out in that quick down tick, I'm not sure, because I wasn't trading it, exactly what it looked like this morning or where the perfect stop loss would have been based on that opening small time frame price action. But this was just a phenomenal upside move. This is exactly what I was talking about yesterday, where that's the time of day, that price discovery period time of the day, where you can just get these movements where these stocks can go in your favor, sometimes points on momentum, and your risk on them can sometimes be super small on something small time frame. So that was phenomenal. And then Mobileye, we were looking at long on news versus the $29 area. It did pierce through 29, but this is that setup that I love. How many times have we seen this setup? Someone actually asked me what my favorite setup is. I don't think it's this, but this is up there. This is one of my favorite ones. I love the news event that leads to the big gap up where price or time corrects in the very beginning of the day, the very open, that leads to a big pivot candle, in this case a continuation hammer, into that equilibrium zone to go long off that first test of that equilibrium zone space between the 8 and 21 EMA after you get some sort of downside tail for continuation. So a couple phenomenal trades out there. Sorry, Mike, I'm not answering your question, but I appreciate you reminding me. So let's take a look at your question. You took the inside 5 and up in DraftKings in the second 5-minute bar of the day. I like it. I had my stop a few pennies below the inside 5 at 44.19. I covered my risk pretty quickly, and my game plan was to be a little greedy with it, as I really liked the weekly chart. 1 second, please. As I really liked the weekly chart, and I thought if we could get a move off the FOMC, which I thought was the lower probability, and we closed well, I could potentially swing it to try and maximize profit. I'm loving all of this. I hope you executed it as you're describing. As it came back down to my stop, I was thinking of moving my stop to the low of the day, because I thought that's how I would know my idea was really wrong. But I would have been adding on new risk to my existing position and also moving my stop, which I don't ever do. Just wondering if you have any rules for this type of scenario, or if you have ever, or if you have any thoughts on it. Sure. So I don't like the idea of moving a stop on a trade that you're already in it. You bought it with a specific game plan of utilizing the inside 5 low as your stop. I'm not going to judge for the moment whether that's the right or the wrong stop. All I'm going to judge is that you had this game plan, you executed based on that game plan. So at that point, even if there's a flaw in the game plan, in this case the wrong stop, or maybe the wrong size because of the stop or the risk or whatever, I don't think that you should change. I think that, once you are in, you want to be super, super disciplined as to the game plan that you had originally created for yourself for that trade. And then, let it play out. And then you can reassess at some point in the future whether or not you actually had the right game plan. And then maybe in a similar situation at some point in the future, you want to adjust to do a better game plan and trade based off that better game plan. But now that you're already in the trade, I don't like to change the game plan after you're already in it. So that would be my thoughts on your question. Also, just want to point out, love your entire thought process here. You found a name that was trading on good relative volume, so it was in play today when the rest of the market was boring. Great looking daily chart. You missed the 44 breakout, but you found a continuation setup with the inside 5 lit up shortly thereafter. And you had a thought process of, I know the Fed is today, this thing's trading really well. If I have any sort of profit cushion in this thing into the Fed, I'll just make sure my stop is out in case this market tanks on the Fed. I'll get stopped out. I'll make money anyway. It's a win-win situation. But if the Fed moves in my favor, this could really, move with me also. Those are the types of win-win situations that we want to be continuously putting ourselves in as traders. So that's just a phenomenal job. It closed great, and I hope you're still in it, and I hope you're maximizing your profit. So great job there, Mike. From Rich, we used to see former Fed Chair Greenspan was carrying his. Yeah, I remember those days. I remember Greenspan. I wasn't trading at that point, but I've definitely heard this. Whether he was carrying his briefcase into and out of the meeting. That was the only reading between the lines back in the day. Yeah, trying to figure out. Or I heard once with Volcker that people were trying to figure out based on his stack of papers that he was bringing into the meeting to speak off of, the size of the papers, what that potentially meant on what he was going to do, and trying to react off of that. Different times. Thanks for the commentary, Rich. Or his cigar, okay? From Dave S. When trading a hammer pivot, does the probability of the trade working increase if the prior candles are all trading in the same direction? And if so, how many candles do you want to see in a row before having conviction on taking a trade this way? I personally wait for either 3 or more 5-minute candles into a hammer, or an ignition candle followed by another follow-through candle, and then a hammer. So appreciate the question, Dave. The one piece of clarity here that I would mention is what type of hammer are we talking about? So first of all, I would say with any candlestick analysis, the information that you're able to get from the candles that are around the candle that you're analyzing, in this case a hammer, what the candles look like before it going into it, are extremely important and are probably going to be the difference on whether or not it's a good trade or not a good trade. I don't think that pure candlestick analysis in a vacuum works, where you're just analyzing the shape of a candle and not looking at anything else and expecting that you can make money that way. You need to know what the trend looks like on multiple time frames, and you need to know what the setup looked like into the candle, in this case the hammer candle, is that you're looking at. So yeah, the candles around it are super important. I think it matters a little bit if you are talking about a continuation hammer, which is basically a pullback into that equilibrium zone, and then a hammer for a pivot that will create a higher low for trend continuation, or more like a reversal retracement hammer, where you've got a really weak stock that's getting extended to the downside, and then that hammer's coming in. So I think that it's a different circumstance there, basically. With the retracement one in particular, I really want to see some heavier selling into it that's creating the bigger extension to take the long. When I'm talking about a continuation hammer, I don't necessarily need that. It could be a couple of lighter volume pullback candles into that equilibrium zone, and then you're getting your pivot for continuation. But regardless, the candles around the candle that you're looking at in any sort of candlestick analysis is extremely important. It's something that you want to pay attention to. March 15th QQQ 1005 candle. Talking about a 5-minute candle. March 15th, 10:05 candle. Yeah, this one's okay. You know, third bar down, I do think is oh, you want at least that. So you got third bar down, you got some extension there at lows, then your hammer comes in, it kind of gives you the volume confirmation that you are looking for. And that's a good trade. I like that one. That's the type of retracement reversal, for lack of a better term, reversal candle that I was just referencing. Yeah, nice picture there, Rich. I'm assuming that's Volker, right? I'm not even 100% sure what it looks like. A little before my time, Volker. Yep. Cool. All right, what else, guys? What other questions do we have? I'll pop over into the YouTube, see what's going on over there. Getting some commentary on the skunk pet. Love it. What's up, Mike? What's up, Kevin? Gabriel? DraftKings, yep. From Kevin, would you say, given past macro news trends, day 2 is likelier to get continuation into all-time highs? Yeah, when it comes to Fed movements, Fed days, usually actually the bigger move is the day after. Not always, but usually. So we'll see. We'll see if that plays out again tomorrow. We should certainly be prepared for it because there's room for this market to really continue and extend higher. We were just analyzing our extension rules, and we're just barely getting into that no man's land. We've had like a month of consolidation here for the SPYs and the Qs, so there is definitely room for this market to extend higher. Cool. From Ryan, back to Mike's question / trade. I also got stopped on the DraftKings trade. I don't think that Mike said he got stopped. I'm hoping he didn't. Maybe Mike can confirm. But you're telling me you got stopped. I'd be curious to know if you took the same trade that he did with the inside 5. Oh, you did get stopped on the inside 5? Let me look at this again. Oh, you got stopped out in this pullback here? Aha. I gotcha. Yeah, I see that. I see that low breaking by a small amount. Okay. Is what it is. I'm seeing in my own trading, I'm getting stopped out of a decent amount of trades by a few pennies lately that end up working. Last week you mentioned the rule creation phase that newer traders are in, and I'm definitely in that phase. Building out my style and rule set. It feels like I'd make more money than I'd lose by giving it more room to my trades. I'm liking what you're saying up until this next part, 5 to 10 cents at most. That's the part I don't like. But clearly, folks here are using one penny below for a reason. Would love your thoughts. Sure. So I'm gonna say as a general rule, with trades where there's some optionality on what your stop loss can be, in the way the modern market has been trading, I prefer a wider stop. Meaning, if I'm looking at this trade here that Mike was talking about with this inside 5 and up for continuation, if the inside 5 is a correct appropriate stop, but the low of the day is also a correct appropriate stop, I'm probably going to go with the low of the day. And that's just because this market environment, I think, has been doing a lot of whippy price action where you can get pushed out of trades a little bit more easily, and you're better off using the stop where, like, back to Mike's point, where you know that your idea was wrong. So I prefer this stop for the same reason Mike said. This is the stop where you know the idea was wrong. I also do think, though, going back to what I said originally, that if you create a game plan for a trade and you're already in that trade, you should follow the game plan that you created for it. And if you want to make adjustments after you're out of the trade for similar trades going forward. So I prefer the wider stop. I prefer feeling confident that my idea was wrong. And in this case, similar to what Mike was saying, you're probably not so confident that your idea is wrong here. You're just using that tighter stop because you can. It's the low of the inside 5. Technically shouldn't be able to break, but the way this market moves, there could be a lot of volatility, and you could just totally get pushed out of that and still have the trade work. What I really don't like is randomness. What we're trying to do as traders is take the randomness out of markets. There's already a ton of randomness in there. You know, just saying, hey, this is where my stop loss should be, so I'm going to give it an extra 5 cents, extra 10 cents, extra 25 cents, extra $1. What's the difference? It just all becomes random at that point. So I don't like that. I want the market to tell me what to do, not for me to tell the market what I want it to do, right? Meaning, I want, what do I know? I know that like a pivot low is important because a pivot low is the spot where buyers took control from sellers. That is inherently an important price point because of what occurred at that place. So I want to utilize that as a stop loss, as an example. And look, you can't drive yourself crazy, Cody, if you're listening on RUVixie Trade. You can't drive yourself crazy if you get shaken out of something, if you get stopped out of something at the low. We work in a game of probabilities that will inherently happen no matter what stop you use. You use the random stop, you use the wider stop, you use the tighter stop. There will always be times where you're going to get pushed out of the position by a couple of pennies, and then the trade works fantastically well, and it does it without you because you got shaken out of the trade because the market downticked a little bit too much or whatever the situation is. That's one of the hardest things for being a trader, is because we get in our heads and we have a recency bias. We always assume that the last thing that happened is the most important thing. This trade shook me out by 3 pennies and then worked, so therefore my entire game plan and everything I've ever done is wrong. No, that's not the right way to think about it, right? That's not going to breed consistency. Doing things randomly, giving random room is not going to breed consistency. So let's let the market tell us what to do, and let's not be upset on that occasion where we get shaken out of a trade that works. At the same time, though, you should pay attention, Ryan, like you're saying. If it seems like you're getting shaken out a lot, by a little bit, and then they work, okay, well then maybe that's something that's more noticeable. It's not just a one-off. Over the course of the last month's worth of trades, this happened this percentage of time, and it seems like an unusually large amount, so maybe there's an adjustment to my game plan that needs to be made. So, appreciate the question, Ryan. It's a very good one, and I hope that helps. From Jeffrey, what data source would you use for correct ex-div dates? The ex-div date for the IWM varies depending on the source. That's interesting. I've always very simply just used Yahoo Finance, and I've always found that it was correct. Not sure if anybody else has some feedback for you on that. From Austin, hey Austin, it's good to see you again. It's been a little bit. Would an inside 5 and up be appropriate on GDX today, second candle of the day, or am I not not really inside and up trade? Sorry, 1 second. All right, so I want you to think for a second, Austin, because it's a good exercise. Based on your question, you're asking me about an inside 5 and up. I want to analyze your trade for you and help you. What chart do you think I'm going to pull up first? Taking you a second to type, to think. What chart am I going to pull up first? That's exactly the right answer. You're asking me about a question on a 5-minute chart, but what I want to see before I look at the 5-minute chart is what the daily chart looks like. The daily chart's where we want to take our cues from. This is the most important time frame, I really think, and then everything that we do, even on our smaller time frames, should be based off of what we're seeing on the bigger time frame. So, on our bigger time frame, that was a good uptick. 1 second, please. On our bigger time frame, we know GDX has been super strong ever since it broke this descending channel back here. Phenomenal move. Got a little bit extended. It was trying to flag. The ADMA caught up, but there was a wide spread between the 8 and 21. So you had a bigger downtick yesterday, and then it looks like a gap down this morning. but just into the lower band of equilibrium. So not the end of the world. This chart still looks really bullish. If I'm trading a gold miner, I also need to have an idea of what gold itself looks like. GLD chart looks fantastic. It spent the last week plus pretty much going sideways, letting these moving averages catch up. So all that looks really good. So based on what GLD and GDX are telling me, I know that these are charts that I am interested in potentially looking for long setups on smaller time frames. So now the market's open, you're looking at your smaller time frame, and here we are. You are asking me about an inside 5 and up on the second candle of the day. I don't love it. I don't love it. I love the daily chart and everything like we just discussed, but remember, inside candles, if you take every inside candle that you see in the market, you're going to lose money. Inside candles are execution strategies specifically for when you like other things. So what else do we want to see? Well, we got the daily chart looking good, so that's good. That's definitely a plus. But you really want to try to avoid trading inside bars within periods of consolidations. They tend to be not meaningful, right? We want to be trading inside candles. Thanks, Bill. We want to be trading inside candles when there is trend, when there is momentum. What I'm looking at with this chart is, yeah, you got a gap down, you got initial uptick, but now it's sitting at the gap fill and moving sideways. And it's also on a day because it's the Fed day where we're not expecting a lot from the market or necessarily from individual stocks unless there's some really big volume confirmation like there was with DraftKings. We're not expecting a lot from the market until 2 o'clock. So that makes me not really like this trade very much. If you're a super gold bug, maybe you want to go after this with some small risk. I could totally live with it. Again, especially because I like the big picture, but when you break it down to this 5-minute chart, when you break it down to this inside 5 here as it's set up, it's right in the gap fill area. It's just consolidating in a tough spot. There's no trend here. There's no momentum here. There's no volume confirmation here. So it makes me not love it. Appreciate the question, Austin. Back over to the YouTube, I see a couple other little questions that popped in from Steve. As recently as yesterday, you were saying market flavor may have gotten more bearish. Yeah, I was describing it as neutral. How does today's post-Fed action adjust your thinking? Yep, it's no longer neutral. the bull is back on. I think that's even the title of my YouTube video for today. JPow says bull on. What we have been discussing every day with our consolidation, with the market, with the SPYs and the Qs, is key levels that the market needs to get above or below in order to either go back to being bullish or for a bigger change to the market that actually can make us bearish. And today we broke out of almost all of those levels to the upside. SPYs broke them both, the March 14th high and the March 8th high. The IWM broke 203 and that 205 quarter. The Qs is the only one that only broke 1 out of 2. The Qs got above that Thursday high, but they are still below the March 8th high. So you could make an argument to me that the Qs are still kind of in neutral turf, but the IWM's in full-on bull mode, the SPY's in full-on bull mode, and the Qs broke one of the 2 levels. Hard to say that this market's neutral right now. The technicals are looking beautiful. The Fed is supporting the move. They're saying we're going to be pumping in liquidity. This market's starting to look really bullish again. Appreciate the question, Steve. Size down for a wider stop. Yeah, so generally, this is the other question in YouTube from T Squared. So when you are trading, sizing is, I always say it's the last part of the equation. So you need to know how many dollars you want to risk on the trade. You want to know how much space there is between your entry price and where the stop loss needs to be. And that difference, I call it space risk. Well, the more space risk, the less tier size for the same dollar amount of risk. Or the less space risk, the more tier size for the same dollar amount of risk. So yeah, if you're going to going back to DraftKings, if you're going to take this trade, if you're going to buy the break of the inside 5 up at $44.47, if you want to use the inside 5, that's going to be much less risk than giving it to the low of the day. So if you're going to use the inside 5, you can take more size. If you're going to use the low of the day, you have to take less size for the same dollar risk. There's something definitely to be said. My preference, if I was in an ideal trading world, would honestly be to continuously use the tighter stop, because I prefer to have more size. You'd have better risk-reward ratios if you're able to have that, because you can have more size, more game planning flexibility. But this market environment has been an environment that pays you to be a little bit looser with the stop and use the broader stop in this case, or in a lot of these examples, than the tighter stop. When possible, I prefer to have more size. Another thing that you can consider doing is taking this type of trade with 2 stops. I'm buying, 1,000 shares with the inside 5 low as a stop and 400 shares with the low of the day as my stop, assuming that the dollar risk of that math works out appropriately for how much you want to risk. And then you've got the extra stock for the momentum if it just bam goes and pays you. Recognize that there's a higher probability you could get shaken out of it, or the wider stop, but you also have stock with the wider stop in case you get shaken out and the idea still plays out. You still have some stock for the real move. So appreciate the question, T squared. All right, gang. Looks like we got through everything, all the questions. I appreciate all the questions. Hope everybody had a good day today. It was certainly a wild one. Have a wonderful night. I will see you all tomorrow. And you know what to do if you're in the YouTube. Press the thumbs up button.